So let's also look at who has to prepare cash flow, because if you don't have to prepare them, well, why would you? Isn't it easier just not to do it, right? So if you're doing general purpose financial statements, whether that's tier 1 or tier 2 simplified disclosure, you always must have a cash flow statement. So you've got those 3 main categories: operating, investing, and then financing. It's very much a substance over form type of approach we're dealing with. I've explained a little bit about what are operating, investing, and financing. And so I've picked 7 transactions here. And for each one, what I want you to think about is, would this transaction be coming into the cash flow statement as an operating activity, an investing activity, or a financing activity? Daily till takings in a cafe. Bank interest received. We'll come back in a few slides to the answers to these. The repayment of a Div 7A loan by a shareholder of the company. Where's that going to sit in the cash flow statement? You need a trial balance at the start of the period and a trial balance at the end of the period. Now, whether that period is interim reports for 9 months, whether the period is 12 months for the full annual period, it doesn't matter. As long as you've got a trial balance at the beginning and a trial balance at the end, and proviso there, they come from the same system and they're in balance with each other, you will be able to get your cash flow statement to balance, guaranteed. I've got a movement in my PPE now. Because PPE comes back to depreciation, I'll come back to the split here. For the moment, I'm just going to assume all of that was acquisition, but I know in my mind they bought and sold some things, so I want to come back. Accumulated depreciation. The movement there will, if we sold some things, maybe there's some adjustment to sale, but otherwise, movement in depreciation is going to be a non-cash transaction.